when should I use an MCA? How does it compare to everything else?
If you are a small business owner in the US, you will get offered this. It's almost inevitable, one shape or form.
What's the back of the envelope math that an owner needs to do to evaluate these sorts of loans side by side?
They do not use that in the MCA world. They use something called a factor rate.
Welcome to Ask Frank, where in 15 minutes, we have an expert answer one of our audience members' questions. And today we're really lucky to have Gerri Detweiler. Gerri spent more than 2 decades as one of the most trusted voices on small business credit and financing in the US. And she's also an education consultant at NAV, the small business credit and lending marketplace. So Gerri, thank you very much for joining us.
Thank you.
So Gerri, this question we get almost weekly through our social media from one of our business owners. And it's, I run a small business and I'm struggling to get credit from my bank. When should I use an MCA? How does it compare to everything else? And so, look, let's get into it. If you could set the scene, when a business owner needs capital.
Yeah. So let's start with what this product is. So, because if you are a small business owner in the US, you will get offered this. It's almost inevitable in one shape or form. And it can go by the name MCA, Merchant Cash Advance. It could go by BCA, Business Cash Advance. But basically, it's a product that analyzes your past revenue and then based on that, uses an algorithm to predict how much it's safe to advance you. And then you pay it out of future revenue. So it came out of sort of the credit card processing world where, you accept a lot of credit cards. Maybe you're a salon, a dentist office, whatever it is. You get a lot of credit card sales. So then your merchant processor, the place that would process, your sales for those cards, would offer you advance and then take a little bit out of each sale after that until it was paid back. And then as it's evolved, it's moved into a lot of different options for small business owners. Sometimes you have business cash advances that are less tied to credit card revenue, but toward maybe your bank deposits, or maybe you use PayPal in your business or Amazon. They're probably going to offer you some type of financing that's similar to this, right? It's the concept of past revenue equals a future advance. Technically in the US, the industry has worked very hard to not be classified as loans because that means they would have to fall under lending regulations, which have different requirements. So they very much focus that this is an advance against future revenue, and we're going to take it out of your future revenue, whether that's your bank account or your merchant account.
And when you're looking at how like an MCA stacks up against the other instruments that are in the market, right? So, you've got lines of credit, equipment financing. I guess what's the back of the envelope math that an owner needs to do to evaluate these sorts of loans side by side?
Yeah. I mean, the back of the envelope math is a little hard because at least in the US, we're used to comparing something called the APR, the annual percentage rate, right? So that's how we shop for a car loan, a credit card, a mortgage, whatever it may be. They do not use that in the MCA world. They use something called a factor rate. So let's say you're going to get advanced $10,000. The factor rate is 1.2, right off the bat. The minute you sign, you owe $12,000. They multiply the advance by the factor rate, and that says how much you have to pay back. So unlike a loan where, you sort of borrow amount, pay it back, and then pay interest over time, here the APR, annual percentage rate, is very tied to how quickly you pay it back. And that can vary with this product, right? Because if it's a percentage of your sales that is taken to pay it back, then maybe sales are great. You pay it back quickly. Maybe sales are slow. You pay it back more slowly. That really affects the APR. Now, there is a formula. We can share that if someone wants to do the math themselves, or you can just use an online calculator. There are several that will, give you a rough estimate. It's going to be a little tricky as a business owner to figure it out because you may not know exactly how, quickly you'll be able to pay it back, but you can get a rough idea. So at least you can compare. And the reason I say that's so important is because it may turn out that your credit card that charges you 19.8% interest might be a better deal than an MCA, maybe. But maybe you can't get enough money with the credit card, and maybe you could with the MCA. So it's just helpful to have it as a reference point. But I also really encourage a business owner to think about that total payback amount, and figure out. It's not always easy because business owners aren't always accountants, right? I don't love doing the math. They don't love doing the math. but you compare it to what's the return, and that's where you decide, hey, does this make sense for my business or not?
And so if I understand it correctly, to your point, or to your earlier example, where you borrow 10,000, the factor rate's 1.2, so you pay back 12,000. Is it done on equal installments across that certain time period?
Right. Well, technically, you're not borrowing; you're getting an advance.
Sorry, you're getting you're getting an advance. You're getting an advance.
I only say that because I would get in trouble if I made it sound like a loan.
Yeah.
No, you typically you have a holdback rate. So that's the percentage of the sales that is used to pay it back. I think this is one of the areas, besides not really understanding the cost and just thinking, 1.2 equals 1.2. I think this is the area where business owners get the most confused and run into the most trouble, because it's not just about the money you're getting now. You need to think about how that payback impacts your cash flow. So what will that mean when the next sales that you make have this 10 or 20% taken off to pay that back? And that's really key to success with MCAs, because business owners who don't have success with this financing typically take it very quickly without understanding the cost. And then they forget that I have to pay this back out of my revenue. And sometimes that's regardless of how the business is doing. They don't factor that. It's not the factor rate, but they don't factor that payback into their cash flow. So then what happens is they end up getting another MCA. And remember, each time you get one, the cost is built right in there, right? Automatically, the minute you sign, you are on the hook for that full amount, including, the amount of the factor rate. So you are rolling something that you already paid for into something that you have to pay for again. And that's where we really see it become, a negative cycle that can hurt the business owner.
So then I guess kind of stepping away from the negative, and you briefly touched on it, like what's the version where the operators selected one of these and it's worked out really well?
Yeah. So typically the reason people choose this financing is it's fast and easy. So you don't necessarily have to have good credit, because usually they're not that interested in it. It's really based on the revenue that your business is bringing in. And that's really important for some business owners. They don't have good credit, personal credit. Maybe they don't have an established business credit. Maybe they don't have a long time in business, but sales are going great. And I'll give you an example. A friend of mine has gone from being a nurse practitioner working at an emergency room to her own medical clinic, and it is going crazy, right? I mean, it's just growing so rapidly. But with that rapid growth comes a lot of other, expenses. And so she has the kind of business where, because she's taking a lot of credit and debit card sales, it's very easy for her to get this kind of financing. But a bank might be more reluctant when she's only a year old for her business. And in the US, at least, usually most lenders like to see 2 years in business. It's not a hard and fast rule. There are exceptions, but usually they like to see 2 years in business, and they may want to see detailed financials, which in her case, the rapid growth might be a little hard to pull together quickly. So this is one of the analogies that I saw about this type of finance that I think makes sense. It's like the fire extinguisher, it's there. You need it. It's an emergency. It makes sense. You're not going to call the fire department to put that fire out on the, because someone left the burner going, but you need to act quickly, and it can be successful. What I think the message that I like to, warn business owners about, if you think through these options before you need them, you're going to have more options in most cases, right? It's when you're, back up against the wall that has to be taken care of immediately, and you have no other options, that you're probably going to feel like you didn't get the best option. You're going to feel like you got pushed into it. But when you've looked at other options, say, hey, these other options don't make sense for me, or they don't work for me, or I can't qualify. Then okay, if this makes sense financially, then I can make it work and then build my business to qualify for other types of options in the future.
I think, though, that you touched on something, that's certainly worth kind of highlighting, which is that growth rate, right? And I think when you're able to look forward, because this is, it's not a loan, it's based on the future revenue. As long as you've got that growth rate and you're confident in that growth rate, then, there's going to be enough flowing through after that repayment, right? To the bottom line of your business.
And if the margins are there, right? If the ROI is there, right? If you're doing it because you money isn't coming in fast enough, then maybe there's another option you need to look at. And maybe you're a B2B business, you need to look at invoice factoring or something else, right? But if the margins are there, the ROI is there, and it's going to help you get to the next level, then that may make good sense. It's just, I think it's when businesses really rely on it too much and don't really think through what it's costing them, that's when they really can run into trouble with this kind of financing. And it's confusing. I'm not gonna
sugarcoat it. Yeah. And I think that's a really great segue, right? Because, you see some of these businesses, they're 6 months in, they've taken the wrong tool, whatever that tool might be. Mm-hmm. In your view, what is the path out, right? Do you refinance? Do you try and consolidate? Do you try and ride it out? I heard you talk about stacking, which, try and stay away from. Mm-hmm. Yeah. What's your advice there?
Well, definitely the clearer you are in your financial picture, the better. And that's true when it comes to just not just understanding your business, but also financing. Lenders love to see that you're organized, that your books are up to date, that they can get the financial statements they need, that you're using a business bank account. I mean, that's so basic, but I can't tell you how many business owners I have talked to who just don't even use a business bank account, right? Money is just flowing into their personal. So that separation is sort of the first step. And then starting to build, solid business credit, work on your personal credit if it's not strong. You don't always have to use it, but there are a lot of small business financing options that will at least check personal credit, even if it's a soft credit check that doesn't affect your credit score. Maybe there's not even a personal guarantee, but they just want to get a feel for you, right? As an individual, as well as, the business. And so working on all those things, then you're in a better position to get better financing. And the honest truth is most business owners end up with different types of financing at different times, right? They don't just go out and get one small business loan and that's it. They use business credit cards for certain purchases. They use a line of credit for certain things. They use, this type comes into an emergency situation, and certain businesses will just have trouble qualifying for more traditional financing. And that's where this can be, very helpful. So while you're thinking, my business is growing rapidly, I'm bringing in lots of money, for some lenders, that's a little bit risky to them. And they may not be as excited about your numbers because they see that it's changing so rapidly. They know it could change rapidly in another direction.
And so if you were to build this checklist, mm-hmm. 3 to 4 things mm-hmm. you would really encourage a business owner to do before they take out any form of or loan or MCA or invoice factoring, whatever it is, what would that look like? I know that you mentioned a business bank account, like bare basics, some financials. Is there anything else?
Business bank account, your books are up to date. You have your business financials can be created from your books. So if they want a profit and loss statement, for example, you can give them one. And then you thought about how you'll use this money, right? You've thought about the use case for it to see if it matches. This is short-term financing. It should be used for short-term uses. So whether it's inventory, whether it's a contract, I remember talking to one business owner who she'd just gotten a big government contract for cleaning. She had a janitorial business, and the surety bond and insurance she had to pay was more than she had cash available to pay it. So you don't always think through all these things that may come along with growth, right? The opportunity also sometimes requires you put some money up front. So it was there are certain times when this type of financing can make sense for your business. But once you're looking at your options, you've already talked to some traditional lenders, you know what's out there, then you can decide, hey, this makes sense for this situation.
The last question that I have is, if you're to give every operator one rule of thumb on capital that they're going to remember, a year from now, what is it? Like, what would your advice be?
The one rule of thumb is to look for financing before you need it and to get it when you don't need it. Because when your business looks good and looks strong, that's when lenders want to do business with you. And I've talked to so many business owners who are kind of risk averse or debt averse. And so they don't look into financing. And then this great opportunity comes along and they're like, what do? I don't have anything lined up. So I'd say look before you need it, and then look when things are going well, when you don't need it. Banks love to lend money when you don't need it.
Yeah. Banks lend to love money full stop, right?
That's right.
No, I think that's again a really amazing kind of piece of advice, which is, when it's used properly, it can be an incredible wealth generating tool for you and your business.
Yeah, absolutely. Very few businesses that are super successful have never used any credit. It happens, but it's not the norm.
Hey, that's amazing. Thank you so much.